Well, good morning, everyone. Welcome across the United States to our final Business of Dentistry webinar. And this is 2022 Tax Planning and Tax Legislative Update. My name is Art Wiederman, and I'm a dental division director at the CPA firm of Eide Bailly. I am out of the Tustin, California office here in Southern California. And I'm now going to welcome my partner in crime and good friend, Mel Schwarz. Hi, Mel. Good morning.
Good morning, Art. Thank you very much. For those of you, I'm sorry,
Go ahead.
Have met me before. Again, great to be with you this morning. For those who have not, I am the Director of Tax Legislative Affairs for the firm Eide Bailly. I travel between Washington, D.C. and a location farther northeast that you see behind me. I spent a number of years on staff at the Joint Committee on Taxation in working for the Congress. Really have been following the tax legislative world for, I hate to say, but now I think about the last 40 years. And hopefully we'll be here to give some thoughts as to where they've been, where they may be going with regard to tax in Washington, D.C., and to answer those questions that you may have about how things are progressing. So again, good morning.
Well, good morning, Mel. And it's really cool to have you on here because we just don't get the perspective of what's going on with Washington, and you're kind of the eyes and ears of our firm when it comes to tax legislation and tax policy and everything. So I'm going to start this off. Mel and I are going to kind of do a dog and pony show here. I'm going to talk about some things, and he's going to talk about some things, and then we're going to talk about some things together. So I want to also share with you guys that I do a twice a month podcast called The Art of Dental Finance and Management with Art Wiederman. If you have not listened to it, I invite you to do it. You can get to it through your podcast app on your iPhone or your Android or on the internet. Tomorrow will be my 4-year anniversary of doing this podcast. December 3rd of 2018, we started the journey, and we're now up to about, I think, 165 episodes, and we have covered everything that is imaginable in the dental profession regarding finance, management, and a lot of really cool stuff. So if you have a chance, listen to that. So here's kind of what we're going to talk about today, folks. I want to give you a little update on the Employee Retention Tax Credit and the HHS Provider Relief Fund issues for dental practices. Those are still on the forefront that you need to be aware of. Mel is going to cover, now we know who controls Congress, and we know who controls Congress now. Even not the Georgia election in a couple of days is not relevant, but it is not going to change who controls Congress. Mel will talk about that, pending new legislation. Then we're going to go into lots of ways to save taxes for you. And that's what we're going to do. Equipment purchases, retirement plans, lots of good examples. This is going to be really good. So I'm very excited. So I'm going to start off by talking about the Employee Retention Tax Credit for 2020 and 2021. For those of you who are not aware, this was part of the CARES Act that was passed, $3.2 trillion, which basically, believe it or not, Mel, I don't know if you remember, the CARES Act was passed unanimously, I believe, in both houses. I don't think anybody voted against it, if I remember correctly. And it included many, that's where we found PPP. That's where the HHS came from. And that is where the Employee Retention Tax Credit came from. The Employee Retention Tax Credit pretty much was not available to dentists for the first year until the end of 2020, I believe it was. Because the original rule was if you got a PPP loan, you couldn't get the ERTC. Well, in the second stimulus, I think it was, they changed that rule. And then I had to learn about the ERTC, and I've been living this now for about a year and a half. And we've done over 125 ERTC projects for dental practices that have gotten over $5 million for dentists. We have spreadsheets that would boggle your mind that if anybody ever looked at them, we've done the rules to a T. So basically the way this works is that if you had a greater than 50% reduction in your revenues for the second quarter of 2020. It could be for any quarter, but the likelihood is 100% likelihood is you're going to qualify in the second quarter, because that's when the government was shut down. That's when dental offices were shut down in the second quarter for the most part in 2020. So if you had a second quarter reduction in 2020 versus 2019 of more than 50%, you automatically can use the wages from the second and third quarter. There's a rule that says you might be able to use the wages from the fourth quarter. I'm not going to go into all the program rules. So that door is going to close in about 5 or 6 months. So if you think you're eligible, I got a call yesterday from a big practice. Gee, Art, I've been hearing this and my accountant can't do this. Can you do this? And yes, we can. If you had a greater than 20% reduction in the 2021 year, we can look at the first quarter, second quarter, and third quarter of 2021 versus 2019. Or we have this thing called a look back rule that says we can use the fourth quarter of 2020 versus the fourth quarter of 2019. The credit for 2020 is 50% of the wages up to a maximum of $10,000 in wages. So the maximum credit per employee for the 2020 year is $5,000 for the whole year. For 2021, it is much more robust, and we've qualified many doctors for this. It's 70% of the 10,000, and it's on a per quarter basis. So you could end up with only 5,000 for 2020, but you could end up with as much as 21,000 per employee for 2021. It's very robust. Like I say, you have about another probably 7 months, or so I said 5, maybe 7 months to take advantage of 2020, and you have pretty much till the end of 2023. And if you'd like us to look at it here, my email is here. You can give us a call and we'll be happy to do a preliminary complimentary analysis. Okay. Now, warning, 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 Will Robinson, right? Well, that was what it was, Mel, in Lost in Space. Warning, yes. Warning. And I'm going to have Mel chime in on this because he's got some information. Okay. There are 2 ways that you can qualify for the ERTC. One of them is through the mathematical tests. And by the way, folks, remember that when you do these mathematical tests, any quarter that you got HHS or other government aid, not PPP, but HHS, you have to include that in those quarters. You have to be real careful about that. We help you and we make sure we go through all that. But there's another way that you can qualify, which is called that if your business was shut down under a government mandate. Now, let me be very clear here. When dental practices closed in March of 2020, and I interviewed on my podcast the executive director of the ADA and the president of the ADA, and they both said the same thing. There were no government orders at that moment to shut dental offices down. They were strongly recommended by the ADA and strongly recommended by the CDC. With that said, many counties and cities did have orders. For example, the city of San Francisco had orders. But for the most part, most of the counties that we deal with here in Southern California did not. Many of your counties did. But when they did, you weren't paying wages. So it says here what the rule is. If you sustained a full or partial suspension of operations due to orders from an appropriate government authority. Now, this is where we have the warning. Limiting commerce, travel, or group meetings, you qualify. So what's happening out there, folks, is there are companies. I got a call on my cell phone from a company in Texas, a very nice young lady. Oh, hello, sir. Have you heard about the employee retention tax credit? And I didn't have the patience to play along, but I said no, and I'm not interested. But they are calling you on your cell phone. They are calling your business. They're making aggressive and illegal claims that your dental practice qualifies for the ERTC. They're contacting dental practices and all other kinds of business. There's huge, huge fees in this. So Mel, I'm going to chime you in here. So the IRS issued a notice in October of 2022, basically warning employers of this tactic. And the link is here for you, and you'll get the slide, so you'll have this. Mm-hmm. Some of these companies are charging as high as 35% in fees, and they don't inform you a lot of times that you have to add back and amend tax returns, add back the credit to your income, because you can't take a credit and a deduction for the same wages. Now, let me go back here. So Mel, You and I were talking on the phone the other day, and apparently the IRS kind of knows what's going on here. And
Well, yeah, this is the IRS does not always catch on, but they have caught on to this one. And they are very much aware, particularly of these almost boiler room type groups that are pushing the employee retention credit, are pushing it without necessarily gathering the kind of information that you need to support this. Particularly with the additional funding that the IRS has received. And we'll get to that a little later in the program and talk about what that may mean for you as just a normal taxpayer. The IRS this is an area that we are seeing the IRS focusing on. We're going to see a lot more focus. And part of that focus is going to be, one, they're looking at industries where typically there was not a government shutdown order. And as Art pointed out, you almost look at this on a county by county basis, but if there was not a shutdown of dental activity ordered by the government in your area, then it may well be that you'll get a not necessarily nasty letter from the Internal Revenue Service that is going to say, guys, show us your proof. And so I think it's very important that you make sure that really you do qualify. Second step that we know that the IRS is looking at, there's this thing called a John Doe summons. And this is where the IRS goes before a federal judge and says, these promoters are pushing something that is illegal. And in the IRS terms, anything that doesn't work is illegal. Tell the promoter to give us a list of the people that they are working with. And if you are working with one of these boiler room groups to get to claim the ERC, then you should probably expect a little bit more than just a polite note asking you, where did you get your numbers? This is something that they are actively pushing. They have set up 800 call-in numbers to essentially report people who are receiving these very boiler room aggressive type calls. The IRS has it in focus. If you qualify, there is certainly no reason not to claim it. And the IRS is being good, I think, about looking at evidence. It takes them a while to do it, but looking at the evidence that you have. But if you don't have the evidence, don't believe somebody on the phone who says, oh yeah, you must have reduced your activity. Let's just claim the credit. That's not going to be sufficient. That's not going to protect you as the Internal Revenue Service continues to look at this.
And there's also, Mel, a form, an actual IRS form, that if someone believes that a promoter is doing this, they can actually turn them into the IRS and give them their name, right?
That's correct. That's part of their system.
And I can assure you that there's a lot of very, very, I'm not going to say angry, but ethical, maybe, CPAs out there who are seeing their clients being inundated by this and are doing this. And they're saying, this is ridiculous. So anyway, we won't belabor the point. You have been warned, folks. And if you have any questions, feel free to give me a call. The HHS Provider Relief Fund was also part of the CARES Act, and we are now coming into period 4 reporting. So if any of you received more than $10,000 in period 4, which runs from July 1 of 2021 through December 31 of 2021, you will need to report this information on the HHS portal between January 1 of 2023 and March 31 of 2023. Failure to report during this time will result in you having to give this money back. And what they do, folks, is they shut the portal down on April 1. And if you go to report on April 1, they say, I'm sorry, it is too late, and you need to send your money to this address. That's exactly what it says. So that is that on that. All right, so Mr. Schwarz, I'm going to turn this over to you. Mel
Right.
is the most qualified human being that I know to talk to you about what tax changes there have been in this year, as well as what we can expect in 2023 and what you need to know about. So Mel, you now may take, we both have control of the screen. I'm going to stop and you can move the slides forward.
Well, very good. Thank you, Art. And let's start really with talking about here. If we look at the history of the legislation that was passed this year, you really have to look back to the legislation that was under consideration at the end of last year, and what they called, what the administration was calling the Build Back Better program, the BBB. And this was a very, very significant proposal. It included a number of tax increases. It included a significant investment in what let's call green energy programs, and a significant, a provision with significant tax increases had passed the House at the end of 2021. And it actually looked like the Senate might deal with it, but things kind of, well, they ran into some blocks. Now, ultimately, what was the Build Back Better program, the BBB, became what they call the Inflation Reduction Act. We can argue back and forth as to whether it's going to actually reduce inflation or not, but that's the title. So today, when we talk about the IRA, we're not talking about things that you put money in for retirement. We're talking about legislation that was enacted this year. Key element is some of the things that they were talking about in Build Back Better did not make it into the IRA. Build Back Better was talking about increasing rates, both on corporations and on wealthy individuals. That did not make it. We do not have any statutory rate increases in the legislation. There were some significant changes to the way gift and estate taxes were calculated and applied. None of those made it into the legislation. There was some hope that there would be additional relief with regard to at least increasing the limitation on the amount of state and local taxes that you can deduct as an itemized deduction. Unfortunately, that did not make it. And for those of you who are interested in becoming private equity investors, Congress is still trying to figure out what to do with the carried interest rules, and maybe continuing to try and figure that out long after Art and I have left for the golf course on a more permanent basis than we tend to do now.
So that's on that's Tuesday, right?
Yeah, that's Tuesday.
That's what I thought.
Anyway, things that are included, again, not necessarily ones that are going to be a significant, the first two are not going to be, I think, significant in this industry. There is a new corporate minimum tax that's based on financial statements. In order to be subject to this, you need to be number one, a regular corporation, not an S corp, but a regular corporation, and you need to have $1 billion of income on an annual basis. So we're going to move past that. There's also what they call now a share buyback tax, or a 1% fee on doing, again, regular corporation, not sub S, but regular corporation stock buybacks. If this affects you, then it's something you need to look in. But again, we're not expecting this to have much of an effect. What may have some effect, and this relates to, I think, to a lot of what Art was talking about with regard to the employee retention credits earlier on. There's a significant additional funding of the Internal Revenue Service that was included in this legislation. Now, there's been a lot of noise on the internet with regard to this. The sky is not falling. This is going to give the IRS an opportunity to hopefully improve, number one, their own bookkeeping, answer the phones with maybe a little bit more frequency than they do now, but is not going to probably result in the kind of army of Internal Revenue Service agents that some of the more open statements on the internet may be making. For those of you, and once you go past these three, really what is left in the IRA with respect to taxes is a very, very large investment. The Congress, or excuse me, the administration was estimating this at around 379 billion, that's billion with a B, incentives to promote alternative energy, green energy. And if this is something that you invest in, are interested in investing in, or might even be in a position to take advantage of in your own practice, it is certainly a new opportunity that is there. Now, I mentioned the idea that the IRS has a lot more money. Well, what does it really mean for Congress to have given an additional $80 billion in funding for the IRS? First of all, keep in mind the reason they chose the figure 80 billion was because they were trying to hit a revenue estimate target. They were trying to show that they were going to increase government revenues enough to meet a specific target that they had set out. The Congressional Budget Office has said, okay, if you increase it by 80 billion, we'll treat that as $200 billion of additional government receipts. Okay, we don't really know whether that's the case or not, but that's the number they got. And that's why the 80 billion figure is there. They needed 200 billion to plug a hole in their revenue estimate. That's why they chose. Keep in mind, this $80 billion is additional money for the next 10 years. And what is given today can be taken away tomorrow. It is also, the idea was this would be $80 billion in excess of what would normally be the future appropriations, the future money that is set aside. Yet, in fact, we don't know what that additional money to be set, that the normal money to be set aside would be. And that may change. And if you see items that say, well, the IRS is going to hire this army of 87,000 new agents, okay, when? And who are they going to hire? If you look at documents, now the IRS doesn't publish this on their website, but they have released these as public documents. They're really only looking at a net increase of 5,000 to 7,500 agents per year. There are a ton of experienced agents that are due for retirement in the next 5 years. So it really is not clear where these 87,000 new agents, certainly, maybe that's a gross number. It's certainly looking like this is not going to be a net number. And the IRS is going to be pushed to do this more and more by the incoming Congress, is to take the money and spend it on customer service type activities, processing the returns, answering the phones. This is not $80 billion that is being set aside to go at and chase after every taxpayer that they can lay their hands on. It is also going to force, we're already beginning to see the IRS to focus on some things. And this brings us back to the employee retention credit, which is one that they think is perhaps, if you're looking to collect additional revenues, maybe this is a lower hanging fruit. So you know, be thoughtful about that. There is new focus. Be aware of things that the IRS can focus on. The last one, overly aggressive coronavirus claims, that's the ERC. There is, for better or for worse, sort of a suspicion that if you're doing a lot of your business in crypto, you're trying to hide something. That's not necessarily true, but it is kind of a belief that people at the IRS have. So again, particularly if somehow you are taking crypto in payment for your dental services, make sure that you've got record keeping on that. There's nothing that really pushes away a revenue agent, particularly a new revenue agent, better than, okay, yeah, let me show you. Here are the numbers. And when those numbers make sense, then, and when those numbers have support, that is always the best way to get the IRS, who might be asking a question or two, to back down and let you move on with your practice.
Mel, I want to bring up one yes. thing when you talked about, maybe go back to the last slide for a second.
Oh, of course.
Thank you. Overinflated valuations, folks. I'm going to do a synonym here. That is one of the things that we see some of our dentists bringing to us as investments are things called conservation easements, where you go invest in a partnership and they go buy a piece of land and the government calls it a conservation easement. They lop off a piece of it, they make a donation, they take a charitable contribution for. I had one where a doctor invested $30,000 and he was told he was going to get a $161,000 charitable donation deduction. There was no economics to the deal. Now, I know you guys don't do taxes for a living, but does it really make sense if you invest $30,000, you can get a deduction for $161,000? If I could find something like that, I'd be investing in that all day long. The government will be looking at those and others. Mel, isn't there like a list of the dirty dozen tax shelters that are out there?
Dozen tax shelters, and this is clearly one of the ones that is on top. And just to give you a little bit of a Washington spin to this, this is a bipartisan issue, particularly in the Western Mountain states. The leadership of trying to crack down on these overinflated values is largely coming from people on the Republican side of the aisle, because what they're seeing is significant portions of the West disappearing from what should be commercial activity into these conservation easements. Yeah. And there's much to be said for conservation easements over and above the questionation of value. But this is, I think that both sides of the aisle are seeing that this may have gotten a little bit out of hand. And so as that moves forward, additional focus is likely to follow because the IRS, whatever you may think of them, does respond to pressures from Capitol Hill. And one of the pressures right now from Capitol Hill is, what do we do to keep 2/3 of the state of Montana from being converted into a conservation easement so that we can no longer actually do business in Montana?
Yep.
So that is another area. I guess we should also mention what I list as offshore shenanigans. If you think that they think you may be hiding something, if you're dealing in crypto, wait till you try and run your dental practice through a Bahamian corporation. I think we just suggest that you not try and do things like that, despite the temptation that a lower tax rate in the Bahamas may provide. Let's move ahead then and talk about, we've seen what's happened in the election. The Republicans have taken the House. It's going to be a very thin majority in the House. In fact, it's now looking like they will have exactly the same thin majority as Republicans that the Democrats have had for the last 2 years. And we already see there is conflict throughout the Republican Party, and it's going to take a while, I think, for the Republicans to really bring their policies together, determine exactly how they're going to move forward, and make sure that they have all of their votes lined up before they move things forward. Over on the other side, The Democrats are holding on to the Senate either exactly through the 50-50 plus the vice president, should the Republican win the runoff in Georgia, or with a 51-49 majority, should the Democrat win, the incumbent Democrat win in Georgia on the runoff. There are some benefits to having 51 as opposed to 50. But once again, it will be a situation where the Democratic leadership is going to have a difficult time keeping all of their troops in line, just as the Republicans in the House are going to have trouble keeping all their troops in line, because it doesn't take very many to object to the direction things are going before you suddenly don't have a majority anymore. What do we think we're going to see in the way of legislation? Well, first of all, let's talk about Congress is coming. In fact, Congress is back. They came back yesterday. Congress is back after the election. They have some serious things that they do need to deal with before they go home for Christmas. And right now, it's looking like they may not go home for Christmas. The current date for going home for Christmas looks like it's the December 23rd, which is a far cry from the way things used to be. There are the federal government actually shuts down if they don't extend the funding for it by December 16th. That is going to be priority number one. That is what they are spending their time on. They also need to complete the National Defense Authorization Act, so that, for instance, the Christmas present to your favorite Army sergeant is not that his pay stops coming in. So these as they talk about it, must pass legislation. These are must pass legislations. There are a few people who probably would, few members of Congress that might be interested in using shutting down the government as a tool to get something. They are in a vast minority at this point. The government is not going to shut down, but that is what's going to keep them busy. Now, there are a whole laundry list of things that other people are trying to get moved into and legislation considered in the process of this lame duck session. Not on the target here, but put it number one is something to deal with the potential rail strike. Other areas and there needs to be some more money for Ukraine. And really, once you go past that, most of these items are ones which they could work on now, but if they run out of time, are things that we may see more likely to come back and be considered in the Congress that begins in 2023. One that I would point your attention to is the idea of retirement legislation. You may hear this referred to in the paper or in the news as Secure 2.0. It is, by and large, the general thrust of the legislation is acceptable to the majorities on both sides of the aisle, both Republicans and Democrats. The push for maybe doing it this year as opposed to waiting it next year is some of the key authors of the legislation, particularly in the Senate, are retiring and would like this to be sort of the last feather in their cap as they ride off into the sunset. What are we talking about including? Now, again, it's kind of a laundry list. These are all things that there seems to be a general agreement on, maybe not on the exact details, which is one of the reasons they still may not make it this year, because details do take time to get sorted out. But moving on and really trying to, one, build up the individual retirement system, the self-funded retirement system, if you will, the employer-funded retirement system, and also make it somewhat easier to deal with. There are right now, you as the employer, if someone wants to take an early distribution because they have a hardship, you need to get involved in certifying that. the idea is, look, the employee wants it. The employee says, I'm having a hardship. Let the employee take the responsibility. Let them, pardon me. How did we get this far? Let them handle this. The required minimum distribution age. Right now we're at 72. You have to start taking money out of your retirement funds, your private retirement funds, by the time you're 72. The discussion here is to push that out to 75. May not happen immediately, maybe something that happens over a period of time, but something that they clearly are pushing to go out. There's some other technical items here. And I think also one notable item is there would be a right now, if you fail to take your required distribution, you are subject to a 50% penalty. And there does seem to be a feeling that that is excessive, and that there will be a way to reduce that from 50 to 25% seems to be generally the agreed. I'll just reference, without trying to get into the details, because the details are still to be worked out, the idea of being able to make a charitable contribution out of your IRA essentially in lieu of taking your required minimum distribution. They're looking at some ways that would actually expand the availability to do that. That doesn't affect, and Art, if it'll tell me if I'm beginning to steal your thunder, but that doesn't take away the fact that that is a current for those of you who may be at the stage where you otherwise would need to be taking money out of your IRA. Currently, there are some real benefits to being able to run this as a charitable contribution. Now, keep in mind, because what you do is, instead of including it as ordinary income, the money goes to the charity, and you have satisfied your minimum distribution requirement. You're not required to include that in income. Now, that doesn't mean that you also get a charitable deduction for the same amount. No double dipping.
Somebody's going to try that. Somebody is going to try that.
Oh,
I guarantee.
I will. Many people do try that, and here at I-Bailey, we have a form letter that we use to respond when the IRS sends their very nice note that says, guys, you can't have it both ways.
Right, but there are reasons, folks, that you want to do that.
Yes.
Couple of reasons. Number one would be if you're taking an RMD and you're still working, and you want to, for example, a dentist, we're going to talk about the Section 199A deduction. There are reasons you want to get your adjusted gross income below $400,000, basically. Well, if you take an RMD, it increases your adjusted gross income by, the maximum is $100,000. If you can just basically not increase your AGI and not take a charitable donation so that it ends up netting, your AGI is lower and you might qualify. I mean, the child tax credit's $2,000 per child. Now, if you're taking an RMD and you have a child that qualifies, you got a late start in having children. But I mean, there's reasons that your AGI you want lower. So that's going to expand.
It is. I mean, that's almost generally a rule. If you talk about how much of your, if you have already begun to draw Social Security, how much of your Social Security is going to be taxed.
Right.
I think that the percentage deduction, if you can keep your AGI, your adjusted gross income under 400,000, is probably the largest item. Again, almost all of these are going to be taxpayer beneficial.
Yes.
Certainly no reason, if the IRA charitable contribution idea works for you now, certainly that is something to continue to look at. But it is something that we may see some additional benefits coming in the future. I'll double back up. There are 5 or 6 new small employer incentives. If you are a small employer, definitely, essentially small employer now is what, 50 employees or less. So many dental offices are going to qualify as small employers. And the incentives are typically not large dollar numbers, but to have a plan, to have automatic enrollment in your plan, to have other, I mean, almost technical details that improve the operation of the plan. There are a series of small credits, small incentives that are being proposed to be added on. Right now, there already is a credit for setting up a new plan. And there is some significant activity trying to push the idea that was included in earlier legislation that would, for instance, allow a group of unrelated businesses to join together in a single 401k plan in order to keep a lid on what would otherwise be the expenses. And so if that is an area of interest, if that is something that you may qualify, sort of stay tuned, because I think that there is some additional benefits that may be coming down the pike. Before we go on to the next bit, which I guess really hands this back to you, Art.
Yes.
I want to double back to the legislation and talk about a couple of items that were included. As I said, there is 400 some odd billion dollars of green energy type changes. Two things that I would point out. One, there's some real changes for those of you who are interested in a energy efficient automobile. There's some significant changes in how that works. Previously, we've had a situation where only a limited number of cars could be sold under and qualify for the credit under by any particular mark. So you could only sell so many Toyotas. You could only sell so many Teslas. Going forward in 2023, those limitations have gone away. Now, those limitations, there are still limitations, and there's some new limitations. There are limitations that really get into details of where was the car built, where were the parts built, where does the assembly take place. You're going to need to leave that, I think, to the dealer to tell you, do I have a car that will qualify for the credit, which can be up to $7,500 per car?
Yes.
Or not. And that's just simply going to be the nature of that. Yes.
And now that qualifies for a business car or a personal car. So for example, what we've done in the past with these credits, if you are claiming 80% business use, and we have a slide on automobile coming up later, if you claim 80% business use, $6,000 of that credit goes to your corporation. And then if you're an S Corp or partnership, flows through to you personally. And the other is personal. So yeah, it can be a business car or a personal car.
Indeed, indeed. For those, they're all, if you're looking, perhaps maybe you're looking for something for a kid, something that is less flashy than a new Prius.
Yeah, good luck with that for your
also,
kid, right?
Yeah, there is also an ability to claim potentially a credit of up to $4,000 on a used car. This does not have any limitations. It does not, you don't have to satisfy any sort of domestic content requirement if it qualifies as a energy efficient vehicle. And you have to buy it through the dealer because the IRS wants things to be reported and they trust the dealer to report. The dealer is more, it makes sense to have the dealer report and not have you do the paperwork. Let's just leave it at that. But that is also something that is newly available. I don't think that we have too many trucks and buses in the dental practices. But if you're expanding into those areas, we've got something there for you. There needs to be a little something for everyone. So go ahead, Art.
Go ahead. Now I would say the takeaway from this is because, you know, again, and all we're doing right now at Eide Bailly in all of our offices, and certainly in our office, is having year-end meetings with our clients. And our clients are saying, how can I save taxes? And they say, well, you need a new car. You want to buy an energy efficient car. Well, I like, and again, I'm going to pick on the Tesla, not because I endorse or not endorse the car. I believe you and I talked, Mel, most of the Tesla models have met the limitation for 2022 and before, meaning that if you bought one before the end of this year, and I think we talked about Toyota, there are some, I don't know them all. You'll need to check with the key is to check with the dealer and check on the internet and see if it qualifies. If they're over, and I think it's 200,000 of a particular make or model, that once more than those are sold, the credit is not available. So what you might consider is, if your make or model, you want that make or model, but you don't get the credit, wait 4 weeks, buy the car first week of January, and then but then you have to meet all these other rules. It's got the final assembly has to be done in the United States, and there's all these other rules, but you may be able to get that credit in 2023, but not get it in 22. And that's where you have to, like Mel says, lean on the dealer.
Lean on the dealer. And the dealer, if you go to the dealer and talk to them about this now, they will say, why don't you give us a deposit against this new car? Leaving aside the question of whether you should be required to leave a deposit on the new car as a business practice, don't let them talk you into a very large one, because if the deposit is big enough, you could be treated as having acquired the car in 2022 and not in 2023. So
right. Be very careful.
If anybody out there is running a car dealership on the side, I'm sorry, but no, don't do that.
Okay, very good.
All right.
All right, Mr. Mel, I think it's my turn.
Take it away, Art.
Okay, so we're going to kind of do a little tax 101 for everybody here to just figure this out. So I've been a dental CPA for 38 years. Every year we do dozens and dozens of meetings. Fridays in December are very popular because many of the dentists take Friday off and they come in, or we do virtual meetings. So to kind of tell you how this works, how do we figure out how much tax you owe and how much tax you're going to pay? So what's included in your gross income? There's more of these, but you know, the wages from your dental practice, and the wages if your spouse is working in the dental practice, not in the dental practice, wages are included. Interest and dividend income, capital gains and losses, we got a whole slide on that we'll talk about. Your sole proprietor, partnership, or S corporation income that flows through on your K-1 is part of your income. Unemployment compensation, which was big in 2020 when everybody was filing unemployment, but not as much now. Social Security income, your benefits for the most part, if you claim them, are 85% taxable on your federal return. In California, they're not taxable. In most states, I don't believe they are either. And distributions from IRAs. So we start with your gross income. Then we subtract your adjustments to income. And that's your contributions to an IRA, your non-incorporated retirement plans, health savings account, alimony paid, although that is kind of gone away because if you entered into a divorce decree after, I think it was about 3 or 4 years ago, your alimony is not deductible and it's not taxable to your spouse, ex-spouse. So we get to your adjusted gross income. We take your gross income minus your adjustments as adjusted gross income. That also includes a section 199A, which we'll talk about. Then we have medical expenses, state income taxes, real and property taxes. Mel mentioned that you are limited to $10,000 a year. If you live in California, we have a workaround for that helps on some of it, maybe, especially if maybe you've sold your practice. It's called AB 150. And you cannot take advantage of that if you did not make a particular tax payment associated with that by June 15th of 2022, but you want to look at it possibly for 2023. If you have a big practice and you have a big California S corporation income, something to look at. Home mortgage interest, investment interest, and charitable contributions. So once we take your income minus adjustments, minus your itemized or your standard deduction, we'll talk about that in a minute, we get your taxable income and we figure your tax. So in the Tax Cuts and Jobs Act of 2017, if I got that wrong, Mel, you can correct me, the year after President Trump became president, Congress passed that act, and that included a deduction for small businesses. And the reason this deduction came up, folks, is because they dropped the corporate tax rates significantly to 21% on large corporations. And the small corporations said, show me the love. I don't see the love here. I'm a corporation. I'm not getting a corporate tax drop. So they created this 1,400-page set of rules and regulations. If you have trouble sleeping, feel free to read them, called Section 199A. And basically the way it works is it's 20% of your income from your partnership S corporation and also from rental properties. Most of your rental properties will qualify. It's a nice tax deduction. So what they have always done in these types of situations, they have penalized professional people. They said, you know what, if you run an auto repair shop, or if you run a boutique or a dress shop or something like that, a clothing store, we're not going to put these limits on you. It doesn't matter how much money you make, you qualify. But if you're a dentist, you're a bad person. No offense, folks. So we're going to call you a specified services trade or business. And what that means is that if your income, if your taxable income, which I just explained to you, gets over $440,000, you don't qualify. If your friend who lives next door runs a business that is not a specified services trade or business, and they have income of $1 million, they qualify. So being a dentist, we want to see if we can work around this. So here's an example. So Dr. Wiederman has a dental practice, and I'm an S Corp, right? And I made $500,000 in my practice this year. And I took a $400,000 W-2 salary, which we'll show you in a minute is maybe not the way you want to go, and a net income of $100,000 on your K-1. Dr. Wiederman has itemized deductions of $50,000, home interest, charitable donations, the $10,000 in taxes. So my taxable income before figuring my 199A deduction, which is what's based on, is $450,000. Now, if you remember in the last slide I showed you, right here is $440,100. Once your taxable income gets over that amount, you get nothing. Between $340,100 and $440,100, you get a phased in amount of this. But once you're over $440,100, you get nothing. So I'm at $450, I get nothing, right? But since I'm a dentist, I get nothing. That's what this says. However, so what if we make some changes to kind of how we're paying Dr. Wiederman and what we're doing? Number one, I'm only required to take a reasonable salary for a dentist. If any of you are S corporations and you are taking zero salary or $10,000 a year, you are playing Russian roulette, folks, because when you get your S corporation election form, it says right on top of it, congratulations, Dr. Wiederman, you're an S corporation. Now you've been approved. You must take a reasonable salary or else we're going to send you to S corporation prison. No, they're not going to send you to prison, folks, but they're going to come after you because they want their payroll taxes. That's a lot of money for them. So if you're not taking a reasonable salary, I've been an expert witness in court 10 to 15 times over my career, and I had to figure this out at one point. And the ADA in Chicago has books that will tell you what is the average salary for a dentist working as a dentist. And I will tell you that if you took somewhere, depending on your income, of over 100, 120, 150,000, 180,000, I will sit there all day long, and I may not fight to the death for you, but I will fight and say, this is a reasonable salary for a dentist. It might not be a reasonable salary for the CEO of Apple or Meta, but it is a reasonable salary for a dentist based on your profession. So that would allow me to get my K1 to 350 because that's what this deduction is based on. It's based on your income from your K1. So second step is my taxable income is 450, so I get nothing. How do we change that, folks? Well, we can buy a CBCT machine or a CEREC machine or a couple of operatories of equipment. If we get them placed in service by December 31 of 2022, that's 125,000. I can take bonus depreciation, we'll talk about. Or I can set up a retirement plan. Maybe I'm going to put away 75,000. We're going to talk in length about those in a minute. If I do this, I can get my taxable income down from 450 to 325, which is under the 340,000. So now I have a K1 that's 350. The deduction is 20% of that. Okay, so now I'm going to get down to 225,000 for my K1, because remember, my K1 was 350 and my machine was 125, so it's 225. So 20% of 225 is $45,000. And if I'm in a 35% tax bracket, I mean, we're looking at a 5-figure savings. So what you want to do when you're sitting down with your accountant is to make sure you're qualifying for the maximum deduction for the 199A. If you're right at the limit, how can we get it below the limit? Okay, equipment purchases and retirement plans are the two best ways to do that. Putting your children on payroll, that's another conversation we can have. That would get it down. It's not going to do too much for you. But anyway, that's what we do on the 199A. I want to talk about the tax brackets. Now, Mel had mentioned that you're not going to see a whole lot of comprehensive, I don't think, tax legislation in 2023 because you've got a split. You've got a Democratic Senate and a Republican House and a Democratic president. So these are the tax brackets for 2022. And folks, the way it works is you get your taxable income and the first 10%, the first 20,000 is taxed at 10%. Very good. Up to 83,000 is 12. Up to 178 is 22%. And then up to 340. So if you make a taxable income of 340,000, which is a very nice income in this life, your maximum rate's 24%. Mel, you've been in this business a long time. That's about as low as I've seen it.
I think that that's exactly right. I mean, you'd go far enough back when you go far enough back and we were at 70%.
70% earned income tax.
Earned income.
That's when I had hair, which I don't have now, right? So there you go.
But the rates we're going to have a good adjustment with regard to pushing the brackets up, because the one way the inflation does actually benefit us is the ability to build that bracket up so that inflation is not increasing what's subject. And I think, although we didn't specifically say this, looking at the next 2 years, 23 and 24, I'm not hearing in Washington any real appetite for changing these rates. So if we talked about increasing rates, if we talked about a millionaire surtax in the past, I don't see that on the table, at least until we get past the next presidential election. So
right, and that's 20,
I think as you do your planning, you can look at these tables and or have your accountant be comfortable using these tables and move forward with them.
So if you look at these tables, this is 2022 and this is 2023. So I'm going to toggle back and forth, folks. So let's look at the 32% bracket, which many of you may fall in. If your taxable income is between 340 and 431, you're in a 32 and 22. But in 23, that goes to 364 to 462. What that says to me is that you have some opportunities because these rates are indexed like 9%, Mel, 8.5%, 9%,
yes,
because of inflation. So if you have taxable income of 462,000 in 2023, you can go up to there in that lower bracket. But if you have 462 in 2022, you're going to jump into the next bracket. So this is why, it's not going to make that big of a difference, but you want to play the bracket game. The difference between 24 and 32%, if you have a chance to take $10,000 of income, take a look at, is it going to be in a 24 or a 32? That's 8%. That's a lot of money. So these are the brackets. And the nice thing is if you're under 340,000 of taxable income, 24% is not expensive money when it comes to a tax rate. It's very favorable. I know everybody, they say, oh my God, I'm at a 60% tax rate. So remember, there's two things you got to remember. There's a marginal rate and an effective rate. The marginal rate is for every additional dollar that I receive, that's the tax I'm going to pay. So if you are at taxable income of 340 and you get a bonus of $10,000, your marginal rate, every additional dollar of that $10,000 bonus is taxed at 32%. But you may be only paying an effective rate, which is the total tax divided by the total income. And most of you are going to be somewhere between 12 and 18%. So the federal tax rates are as low as they've ever been. So if you're thinking about a large income item, a large income event in your life, 2023, 2024 might be a good time to think about it, because 2025, nobody knows what's going to be happening in the presidential election. But if you end up with one side of the aisle controlling all three of these, and I'm going to say historically, Mel, the Democrat, without getting into politics, and I promise I'm not, historically, Democrats choose to try and raise rates on the rich. Is that correct?
That is, they are certainly much more open to that than is the other party.
Correct. So if you end up with a Democratic president, a Democratic House, and a Democratic Senate in 2020, at the end of 2024, going into 25, that is a real possibility, just like you had a Republican president, House, and Senate in 2017, and that's why they got this legislation through. So anyway, that's tax rates that you want to be looking at and talk to your accountant about. Okay, so all right, how do we save taxes in 2022, guys? We got about an hour left, and we're going to give you lots of ideas. Number one is equipment purchases. Now, we all know that there are supply chain issues, but we also know that Shine and Patterson and Benco and Burkhardt and all these dental companies are gearing up for the next 30 days. And you have the ability to take what's called 100% bonus depreciation in 2022. That is going to start going away, and I'll get into that in a second, starting next year. But this year, if you place, I'm going to throw out if you place a digital scanner for $30,000 in service in 2022, you get 100% bonus depreciation, and you can write that off this year. Point is, it must be placed in service. If the salesperson says, well, just send me a deposit, you can write the whole thing off, I'm sure that's right. No, it's not. You must place it in service. It must be in what's called a state of readiness. In other words, it can be installed. You don't have to have treated any patients on it. It would be better if you did, but you don't have to treat patients. It just has to be installed. So if you're putting equipment in the last week of December, I would encourage you to, if you can treat a patient in that dental chair or use that digital scanner, great. If not, make sure you take photographs that are dated that shows that this equipment was in service and operable on or before December 31st. All right. Now, if you are an S corporation, you must check S corporation basis. And this is critical. So what you need to do if you're meeting with your CPA. So in your mind, doctor, you're going to go buy a CAD CAM. You're going to go buy a CBCT. You're going to buy a big laser. You're going to spend $100,000 because your CPA said, oh my gosh, Art, you had a really good year. You're going to pay a lot more in taxes. What do I do? Okay, buy equipment. So here's how this works is the one question that you have to ask your CPA is, do I have S corporation basis for me to take this deduction? And let me show you an example, and you're going to get these slides. You'll have them. Feel free to print them out and show them to your accountant. And if your accountant says, I don't know, give me a call, because I have seen doctors be very disappointed. So Dr. Wiederman, I grossed $1 million in 2022 and I had net profit of 300,000. Let's just say for my discussion, my S corporation at the end of last year was 0.0, folks. I took a salary out of my practice of 120,000 and 180,000. I took distribution. So the way it works is at the end of 22, with that fact pattern, I took all the money out of my corporation in salary and distributions. My basis is 0. I get to increase my basis by the 180, and then I took distribution, so I'm at 0. So I bought a CBCT machine for 120,000 on December 20th. It's placed in service. Here's the important point. I took a loan from the bank to do this. You do not get basis, okay, for taking a loan out, period. So my basis is 0. I earned 300,000. My basis was 0 at the beginning. I earned 300,000. I took out salary and distributions of 300,000. I have 0 basis before I buy this CBCT machine. I go to do the tax return and I'm expecting to get a huge tax write-off, and my CPA says, or Art says, no, you don't have sufficient basis. You don't lose it. You basically get to take it over a period of years, which is not what you wanted to do. So I have a 0 write-off. So how do I get around that? Number one, check your basis. You can make a capital contribution to the S corporation of $120,000. You could make the loan personally. You can take an equity line on your house. I mean, you can do all kinds of things. Or you can put some of your distributions back as a capital contribution into your practice to create the basis. This is really important, doctors. Okay.
Art, let me ask can I ask a question here?
Yes.
You talked about borrowing the money.
Right.
Now, if I borrow the money, if I have the S corporation borrow the money,
right,
then I've got a problem. I mean, you just described the problem. If instead of having the S corporation borrow the money, I go to the bank, the dentist, go to the bank, borrow the money, take that money and contribute it to the corporation, does that solve my problem? Do I now have the basis that you've been looking for me to have?
Yes, that is exactly what you'd want to do. There's actually a case called Miller that's exactly what happened, and you have to document it. Document that you can make it a loan and get loan basis. The better thing is to make a capital contribution.
Right.
It's your business, doctor. You can do anything you want. You can make you can make distributions to yourself of the payment next year when I'm not buying 120,000 of equipment. So the answer is yes. You need to create the basis, and you create basis by either capital contributions or loans. Loans are a little more dicey. Capital contributions are a lot cleaner. But yes, absolutely, Mel, that does solve the problem. Yeah. Okay, retirement plans. Folks, I am going to go to my grave harping on saving for retirement. I cannot tell you how many doctors, sadly, 3 to 4% of dentists in America will have the financial ability to retire at the age of 65. And that's not only dentists, that's most Americans. And retirement savings have gone down. People are starting to spend more money. We've been cooped up for 2.5, 3 years. We want to go on vacations. We want to buy cars. We want to take trips. We want to do all this stuff. But retirement's important because when you get to the point that you are 55, 60, 65, number one, you get to the point in life, and I've had this conversation with many doctors, I don't want to do this anymore. I've done this for 30, 40 years. I got other things in my life I want to do. And what you do is very physically demanding, back, neck, shoulders, etc. I mean, I'm a dental practice broker here in California, and several of the last practices we sold was because a doctor said, Art, I'm not going to be able to do this much longer. I'm starting to have carpal tunnel. I'm starting to have shoulder issues, neck, back. So funding a retirement plan. We have 3 types that you guys can choose from. Baby bear, mama bear, and papa bear. Baby bear is the simple IRA. It doesn't require any IRS compliance. You basically can walk into a bank or a brokerage firm or your investment advisor. And if you have about $30,000 to $35,000, if you put your spouse on the payroll with a minimal contribution to employees. So if you're just starting out and all you've done is an IRA, but you're a regular IRA, which is $6,000 or $7,000, and you feel like you want to start saving, and your business, your practice is doing better, you're doing some additional procedures, your revenue is growing, but you don't have 100, 200,000 to save, this would be a good way to start a simple IRA. Okay, now I've got some more slides on that in a minute. The profit sharing plan with a 401k is what many of you will have, and you can fund up to $61,000 for the doctor, plus $6,500 if you're over the age of 50. So a total of $67,500 for 2022, and I have the 2023 rates in the next slide. Plus, what we do a lot of times is we put your spouse on the payroll, and your spouse in many cases is doing marketing, running errands, doing the bookkeeping, things like that. And we pay the spouse a $20,000 salary, enough to cover the payroll taxes, $27,000 if they're over age 50. So you can get, between you and your spouse, almost $90,000, $80,000 to $90,000 into a retirement plan, folks. And most times you'll only have to fund about $5,000 to $15,000 for your employees. And you'll have some administrative fees, $2,000 to $5,000 a year, which are tax deductible or can even be paid from the plan assets. So the profit sharing, if you've got, so simple IRA, 25 to 35,000, 30, 35,000 that you can afford to put away. Profit sharing, 35, 40,000 up to 90, 100,000 probably. And then we have the defined benefit plan. If you're 27 years old, that's probably not going to work well, but we have been finding with the new cash balance defined benefit plans, anybody over the age of 40 can do some serious damage here as far as funding to retirement. You can put in $100,000 to $400,000. So those are the three types of plans. So here's some other things to take into consideration. If you do not have a plan right now, you can set one up. It has to be basically, you have to sign an adoption agreement by December 31st. However, you cannot set up a simple IRA for 2022 because you have to have given notice to your employees by October 1st. So that's not allowed for 22. Here's another thing that you want to take into account. If you have a simple IRA, this is really important, doctors. If you have a simple IRA right now, and you've been funding it for all of 2022, and you say, you know, Art, I like this, I'm doing better, I want to fund, maybe your dental practice loan paid off, and you've got $6,000 a month that you can do. I would encourage you to, instead of writing that check to the bank, write it to your retirement account. Maybe you take a little bit of it and save it for college for your kids. Maybe you put some towards paying down your mortgage, but save for retirement. You will thank me and anybody else who tells you to do this, right? So if you have a simple, you must stop funding the simple January 1st. You can fund the last payroll at the end of December and you send that money in the first week of January, but because it's for 2022, you're okay. If you do one payroll and fund to a simple IRA, you are precluded from doing any other type of retirement plan in 2023. So be very cognizant of that. If you want to do a profit sharing or defined benefit in 23 and you have a simple IRA, you must stop the simple IRA as of the end of 2022. You have the due date of your tax of your returns, including extensions, to make this contribution. So you can do this. You can get a deduction for 2022 up until as late as October 15th of next year. For most of you, it's going to be September 15th for S corporations and partnerships. For sole proprietors and C corps, it's October 15th. Fully tax deductible, folks. You're going to save 30 to 45%. The government's going to pay 30 to 45% of your retirement contribution every year. And without going into financial planning, which is my passion, you are going, the amount of money that you can accumulate inside of a retirement plan, as opposed to taking the money out, paying the tax rate, and then paying taxes on the money that's earned, because remember that the earnings are also tax deferred, is astronomically higher inside of a qualified retirement plan and than it is by doing it on your own. But again, with the asset purchases, you must be very careful about your S corporation basis. Same concept. You want to fund, you're going to fund 80,000 or retirement plan, but you've got a zero basis, and then you want to do it with 2023 profit. You may be in for a sad awakening and not be able to have the basis to do that. So it's the same thing here. The maximum salary that you have to take in order to be qualified for a retirement plan, they will not take into consideration more than $305,000. You don't need that high of a salary. You want to check with your TPA, which is your third-party administrator, that can I get away? I've had doctors that have been able to get to the 61,000 with a salary of 150 or 180. It's a mathematical calculation that the third-party administrators are doing. And we at iBailey can certainly help you with all of that. But let's say, for example, you can get away with a salary of 185 instead of 305. That's $120,000. That saves you 4% Medicare tax, 3.8, call it 4, right? 120 times 4%, that's almost $5,000 in your pocket. So for 2023, they've raised the government, Mel, really is pushing small businesses to provide retirement benefits to their employees. Isn't that right? That's what all this Secure 2.0 is about?
That's exactly right, Mark.
Yeah, so they are raising these. So next year, the maximum 401k deferral for under the age of 50 is $22,500. And if you're over 50, the maximum catch-up rate is up to $75,000. So if you are over 50, you can defer $30,000 into your 401k, and combined with a profit sharing and maybe even a defined benefit, you can do really well. The simple, you can't. So that's something to take in consideration. So next year, your maximum profit sharing contribution is going to go to 66,000, potentially 73,500 if you're over 50. And the maximum salary goes to 330, 305, but in a lot of cases, you don't need it. If you guys need help, you're trying to structure a retirement plan, you want to change your retirement plan. I do this stuff in my sleep. It's really, we at iBailey, we have lots of these conversations with our clients. Okay, automobiles. Everybody wants to buy automobiles. And I'm hearing that automobiles are becoming a little more available. Maybe the prices are coming down, maybe they're not, I don't know. So we're going to talk about two types of cars. The automobile, and again, everybody wants to write off at least 475% of their car. We'll talk about that in a second too. So if you buy a car that's under 6,000 pounds, GVWR, that's ground vehicle weight rating, is what that means. You will find that on the inside door of the driver's side. So you open your inside door, there's a sticker on most automobiles that will tell you, because there's a GVR and a GVWR. You got to be really careful. Some of these dealers have told me that it qualifies, and I look in the instruction manual and no, the GVWR is 5,980 pounds. It does not qualify. We'll talk about that in a minute. So the maximum deduction if you buy a car that is under 6,000 pounds is $11,200 plus $8,000 of bonus depreciation for 2022. So that's $19,200. We multiply that by the business percentage. That's 80%. Now, I'm not suggesting that every one of you take 80%, but your business driving as a dentist, as a general rule, driving to and from your office, from your home, is probably not deductible business driving. But if you are a specialist or you own multiple offices and you drive to, marketing meetings and deliver gifts and go to the bank and go see your accountant, go to the lab, all this stuff, that's all deductible driving. So, if in the reality of the world, folks, if you get audited on your car, and I've been through several, they will say to you, okay, Mr. Wiederman, you claimed Dr. Wiederman, you claimed 80% in business usage. Show me your log. And what they do is they choose 3 or 4 months of the year. They will not tell you which ones. So let me see your calendar to show me your business driving for, okay, Dr. Wiederman, February, June, and September. And then you have to go and show them that you drove 80% of the time. And if not, they will disallow. Now, it becomes horse trading, but it's, I never recommend that a doctor has 100% business use. I have had a few doctors who have actually gone to the extent of buying a car, parking it at their dental office, driving another personal car to the office and home, and personal driving, and only using that other car for business. And if you can document that, I will take 100% business use for you. I'll probably cry out of both eyes and not sleep for a couple of nights, but I will do that. But you got to have the documentation. Now, the big bucks for taxes is if your car is over 6,000 pound ground vehicle weight rating. And that's in the owner manual, driver's front door. Okay. If you do that, it's the same as purchasing a big piece of equipment. So let's say you buy let's say a Chevy Tahoe. Okay. Chevy Tahoe is well over 6,000 pounds. That qualifies. Instead of having to be limited to $19,200, you then can take, if it's a $100,000 car, you can take $100,000 deduction times the business percentage that you use. And that is just like buying a big piece of equipment, okay? The question is, do you want to buy that car? Does it make sense? Never. Let the tag tail wag the investment dog. We here in California, our gas prices are coming down. Mel, what's a gallon of gas up there where you are right now in Maine, where you're hanging out at the moment?
I paid $3.79 last night for
Okay, Mel, we are no longer friends. Okay, so no. We're still well over $5 a gallon. Some places $6 in Orange County, and I don't think that these vehicles get 50 miles to the gallon. So it's a cost benefit issue. If you drive a lot, do you do it for a tax deduction? We have to talk about that. If you're audited, you want to justify at least 50% business use, but it's the same thing. If you want to buy a car in the last week of December and you place it in service and you justify that in the last week of December, when nobody is working, you drove 80% for business, right? Then you get to take that week's worth of driving, even if it's only 800 miles or 400 miles, into account for determining what your business usage is. So the automobile is another way to cut your taxes in 2022. Buying versus leasing a car. Okay, so if you buy a car, you get this full big depreciation. If you lease a car, you don't. If you remember that, folks, that leasing an automobile was created by the automobile industry 20 or 30 years ago. And the main reason that they did that was to allow consumers to get more car for less money. In other words, if you can't afford to buy a $100,000 car and make a down payment and all that stuff, we'll let you lease it. You can get a $200,000 car and you just have to make the lease payments. And you've got to be so careful about leasing, okay? Now, it's all based on your business usage percentage. So if I buy that $100,000 Tahoe, I get the bonus depreciation. If I lease the Tahoe in December, I get 80% of one payment, even if I made that payment. It's a much lower deduction, okay? So if you're the type of person like me, I am 63 years old. I have owned 4 automobiles in 43 years. I kid you not. I'm on my 4th one. It is it's a comfortable car. It has 227,000 miles on it, and it runs wonderfully. And I don't have a car payment and haven't for years. And you know, that's me. If you're the type of person who wants the brand new car and you want to change it out every 2 or 3 years, you might want to consider leasing it. And so that you're basically renting a car. You're not going to get as big of a tax write-off. But if you don't drive a lot of miles, you know, and you want the newest model, you should lease. But if you're the type of person like me that you're going to own a car for a long time, you're going to take care of it, and you're not going to have a car payment, you're going to take that $1,000 or $1,500 a month and put it into retirement or pay down your mortgage or fund your kids' college or take a nice vacation, then, you know, buying a car would give you better write-offs and, you know, save you money over the long run. That's my opinion. Children or parents, grandparents on the payroll, okay? So under the Tax Cuts and Jobs Act of 2017, they significantly increased the standard deduction. So folks, we're going to go through a little bit of this now because this is a way that you can save some money too. So for 2022, The standard deduction for a single individual is $12,950, and it is double that for a married filing joint. And there's additional standard deduction for, I believe, blind and over 65 and things like that. So a child or a grandparent, if we put that child or grandparent, say you're supporting an elderly relative, maybe grandma is going to help do your QuickBooks for you or something. We put them on the payroll and it's legitimate. You need to keep time records and employee records for those employees, your kids, your grandparents, everything. So we can pay them up to $12,950 without paying a dime in federal income tax. If you have two teenage children that are helping you, okay? I mean, I have a very good friend who at the time, his son was 13 and he was a PowerPoint wizard and he put together several PowerPoints. And if he were my child, I would have put him on my payroll. I paid him and his income was low enough he didn't have to pay taxes. You might have to pay some state taxes because like in California, the standard deduction is only about $4,800, but it is a significant way to save money on your taxes. So my son, Nathan, I actually do have a son named Nathan. Right now he's 33. He is a computer expert. He's been hired by the practice to help with the website, and he does administrative and office work involving the practice. Make believe Nathan is 15 years old, okay? If we can justify that we paid him for services that are worth this amount of money, we can justify the payment as a deductible business expense. You will have to pay some Social Security taxes on that. But I've done the math, and if you're in the 37% maximum bracket, that will save you just south of $4,800 in federal income tax and some California taxes too. So putting the family on the payroll is something you should consider, but you do need to keep good records and justify it in case you ever get audited. Okay? All right, so the next thing we're going to talk about, folks, is capital gains and losses. Now, Mel, I hear that the stock market didn't have a great year in 2022. Is that right?
Yeah, there certainly whether you had a great year or not probably depends upon when you bought and when you sold. But there are going to be many losses, yes, to be reported this year.
So a couple things to think about. Number one, a stock, a bond, a mutual fund, real estate for the most part, and your dental practice goodwill are considered capital gain and loss assets. So there's two types of capital gains, folks. There's a short-term capital gain, which is for any asset that you've held 1 year or less. Be careful about the 1 year or less. And that is treated like ordinary income, okay? Ordinary income or loss, a short-term, ordinary income. So if I bought some stock in January and you picked the right stock that went up 50% this year, and there are some, energy stocks were up 68% this year. I just did a podcast with our Eide Bailey financial wealth management folks yesterday, and we were looking at all the sectors, and all the sectors were down for 2022 except for energy. Energy was way up. So you had a big, you bought ExxonMobil, you bought Shells. I mean, any of these companies, you could have made money. So if you have held it for less than a year and you sell that at a gain, it's ordinary income. And if you're in a 37% bracket, you'll pay 37% tax. But if you hold on to that stock for 1 year and 1 day, you will pay a tax at probably 15%, maybe as high as 20%. So again, if I have capital, if I can turn something from ordinary income into capital gain, the difference is between 15% and 37 is 22% savings. And the difference between 20 and 37% is 17% savings. For most of you, it's 15%. Now, let's say you have held some stocks that are still in a gain situation, and you sold them early in the year, maybe, I don't know. If you have stocks at a gain, you can sell stocks at a loss and offset them. Because remember that if you have a capital gain, it's much cheaper. So if I have a capital gain, I can offset it with capital losses, and most of you probably have losses in your portfolio. So you want to sit down with your investment advisor and your CPA, look at what your personal portfolio, not your pension portfolio, because that's not going to help you on your personal tax return, your personal portfolio, and see if there's some gains or losses. Okay. If you have a bunch of assets that you've either sold at a loss or can sell at a loss, you might have Apple stock that you've held for 20 years that's still sitting with a really nice gain, or some of the other techs. Remember, last year's stock market did really, really well. And the majority of the gains in the stock market last year, over a third of them, I believe, were from the 6 big tech stocks, the Amazons, the Metas, those types of stocks that just went crazy and that are getting clobbered this year. So you got to look at your portfolio and stuff. And there are instances where if you're in a 10% or 12% tax bracket, if you play it right, you can actually sell stocks at a gain and pay a 0% tax rate. That's right, folks, 0%. Hopefully your taxable income is not lower than 80,000, but maybe you just bought a practice, or maybe you have retired or something. I don't know, but we have to look at that. So capital gains and losses. I want to go back to one more thing on capital gains and losses. If there's anybody on this call or is listening to this recording who are in the process of selling their practices, capital gains are 15%. I just did a calculation for a doctor that's selling his practice, and he has $440,000 of capital gains from goodwill. That's 15%. That's really cheap money. So in that situation, or maybe you sold a piece of real estate this year and you had a big gain, you want to look at your personal portfolio and sell everything that you can that has a loss in it, because that'll directly offset the gain from either the goodwill on the sale of your dental practice or the sale of a piece of real estate. Be very careful, though. The last thing I'll say about capital gains, folks, is that if you sell an asset for a loss and you buy that same asset, that same stock or mutual fund back within 31 days, you do not get the loss. And the brokerage will absolutely report it as what's called a wash sale. So if you're going to sell an asset for a loss, you better make sure that you don't want to own it for the next 31 days. You can buy it back on day 32, but you can't buy it back on day 31 or earlier, or that loss that you tried to generate will not be, it'll be disallowed, just flat out disallowed. Okay. All right. We're getting close here. Itemized deductions. We're right on time. If you have any questions, feel free to put them into the Q&A and we'll answer them for you. I answered a couple of them offline. So if you have medical expenses that are greater than 7.5% of your adjusted gross income, those are the only medical expenses that you are allowed to deduct. So, if your adjusted gross income is $300,000, 7.5% of that is about $22,000, $23,000. Unlikely that you're going to have medical expenses of more than that. However, there are some things in life that you pay that qualify as a medical expense that are not covered by medical insurance. I will think of one off the top of my head: in vitro fertilization costs. I do not believe most insurances cover those, but they are very expensive. And if you paid them, you might be over the 7.5% bracket. So if you think that for medical expenses, you're going to be over the 7.5%, you're probably only going to be over it for 1 year. You want to bunch as many of your medical expenses as you can in 2022. So let's say you spent $40,000 out of pocket for medical expenses, and it's going to give you a deduction. You want to basically, pay for as much as you can. You can charge medical expenses on a credit card before the end of the year, and you can get them as a deduction, even if you don't have the services rendered until 2023. So you want to bunch these together if you're over that 7.5% limit. Remember, your medical driving is per, I think it's maybe 14 or 15 cents per mile. I have to look at it. Okay. So Here's another thing we can do, Mel. We can donate appreciated stock to a charity. And you never, ever want to sell stock and then give the money to charity. So Dr. Wiederman likes fruit. So he buys stocks with the name of a fruit in it. And this year he started at the beginning of the alphabet, and he started with A, and A is Apple, right? Apple is a stock. My Apple stock has gained $100,000 since I bought it when the Apple One came out back in the 1800s, right? That's about when it came out, I think. So I have a gain of 100,000. If I sell that stock, Mel, and I'm going to pay, I'm in a 30% federal and state bracket, maybe 20% capital gain federal, 10% California. Other states might be a little lower, but let's just say 30%. That leaves me 70,000 to donate to charity. I've got to give the government 30,000. But if instead I just make what's called an in-kind donation, in other words, I call the American Cancer Society, the American Heart Association, my dental school, and I go ahead and make a donation of here is 2 shares of Apple stock worth 100,000. I mean, I'm just kidding there, but $100,000 worth of Apple stock. I get the full $100,000 deduction, but you got to make sure that you've held that stock for 1 year and 1 day, because you don't get the deduction of the full fair market value if it's held for less than that period of time. So you can also use something called a donor advised fund. Say you want to donate some stock to charity, but you're not really sure which charity you want to do it to. There are these things called donor advised funds. You put the $100,000 stock in there, and you say, you know what? I want to give 20,000 to charity A and 30,000 to charity B, and in 2 years I want to give 40,000 to charity C. You can do that, and as long as you make the donation in 2022, you get the write-off, even though the charity is not going to get the money till later. Okay. The standard deduction is another thing that we want to talk about, folks. As we mentioned earlier, $25,900. So Mel, we get into this discussion that it got real interesting. A lot of my dentists fell into this. So for federal purposes, I only get 10 grand for my state and local income taxes, right?
Correct.
Okay. That leaves me another $15,900. So the medical expense deduction has to be over 7.5%. As I mentioned earlier, more than likely, you're not going to get a medical expense deduction. Very rare. Maybe you are, maybe you're not. Then that leaves me really 2 deductions. That leaves me home mortgage interest. Well, I understand that mortgage interest rates are now at 7%. We hope they'll come down, but most of the folks on this call probably have a home mortgage interest that was taken out before rates started going up in 2022, and it might be at 3%. You have a $500,000 mortgage at 3%, that's $15,000. So I take my $10,000 and my $15,000. Maybe I don't give a lot of money to charity. Well, I was talking to a client the other day, and for 38 years, I never, ever, ever make any kind of comments about how much or how little money a client gives to charity. I only talk about giving to charity in the respect of it can save you this amount of taxes. So maybe you don't give anything to charity, you give very little. If you have no home mortgage interest, you will get the standard deduction. So you want to, again, bunch your deductions in a year that you're going to benefit. So Dr. Wiederman's been very busy in this webinar, right? So I don't have enough medical expenses to get a benefit. I'm at the maximum of 10,000 for state and local. My home interest is 7,000 for the year, and I gave 3,000 to charity. So my total itemized deductions are $20,000 for 2022. I'm married. Mrs. Wiederman and I file a joint return, and we get $25,900 as a standard deduction. So I'm going to use the standard deduction. So it makes no sense for me to make any contributions in 2022, at least up to $5,900, because I will get 0 tax benefit for them. Again, the standard deduction is lower for the states, so you may get one, but we're talking federal here. So what you might consider doing is bunching a bunch of donations. I mean, maybe you're considering giving $25,000 to your dental school, or to your church or synagogue or religious organization. So any year that you're in this situation and you're going to be over the 25.9, bunch your donations, make donations for 2 years. We did this. Here's a perfect example. One of my clients went to a major university, and that university was trying to raise money for a new press box in their football stadium. And he told me at his year-end meeting that he committed $50,000, $10,000 a year for 5 years. His house was paid for, and he didn't really give much other money to charity. And I said, Doc, you're going to make this whole $50,000 donation this year. Well, I didn't really want to. I can. And I said, because if you do it $10,000 a year for the next 5 years, you'll be at the standard deduction and you'll get zero benefit. Whereas if you do it this year, you'll save about 15 grand. And that's what we did. So you want to bunch your charitable donations. All right. I'm exhausted. So it's 10:42. I think we did a pretty good job of keeping everybody on time. We'll hang on here for a little bit and make some final comments. If you have any questions in the Q&A, feel free to drop them in there. And this is our contact information. Doctors, if you're not sitting down with your CPA and planning out your taxes and saving money, Mel, you've been involved with the IRS and Treasury. While we do not encourage bad behavior in filing tax returns, the law says that you are not required to pay one dime more than what the law requires you to pay. Is that correct?
That is exactly right. And so it is, tell the truth, keep your records, but don't pay what you don't absolutely have to pay. That's right. I think that's what really all these things that you've been talking about are all directed towards a efficient and really a most beneficial way of calculating and managing your affairs so that tax comes in. While we have just a few minutes, I want to mention one other item that I did not get to with respect to the legislation that was enacted this year, the so-called Inflation Reduction Act. And that deals not with your dental practice itself, but with what may be your activities with those charities that you have an interest in. For instance, are you on the board at a charity with a boy at whatever? Are you on the board with a local charity? Are you an officer or have a deacon? You're a deacon at the church. You're at the equivalent at the synagogue. You have some influence on what that entity does. One of the biggest changes in this legislation that was passed is when they took the additional money for environmental things, which they did through credits, through benefits. For the first time, they made them available to charity. Before, if a tax exempt put solar panels in place, that was great. They helped the environment, but they paid for the solar panel. Beginning in 2023, charity puts the solar panel in place, the government will pay 30% of it. And that extends to a number of, and then there's some more esoteric ones, but we're going to assume that your charity is not going to be involved in placing a zero emissions nuclear power plant in place. So we're really talking about things like solar panels. We're talking about, do you have a little windmill, the things that any company might do, property they might place in service that would generate some electricity, would generate some power from let's say, other than just pulling it off the wire from the IRS, from the local utility. Don't lose sight of this. And it's something I think that charities, because they've never been able to take advantage of this before, really didn't focus on when it was included in the legislation. It's there. It certainly fits in very well with those that would like to be able to show that they're reducing their carbon footprint. And as I say, the solar panel is the perfect example. It also extends to some areas, some of the special solar energy generating glass that you can put in windows. Again, they're wonderful things, and the government would now like to pay 30% of the cost for you, and literally will send you a check, because they're going to treat it as a payment of tax. They're going to give you the money back. So be aware that it's there. If you need some additional details, consult with your accountant. They'll know where it is. Give us a call. We can help you work your way through it. It's a little bit of a new world, but it is a way that you can make a contribution to those organizations that you are a part of, that has now been gifted to us through this legislation.
And folks, we all know, those of you that are involved in your church, your synagogue, your not-for-profit organization, not-for-profit organizations are always in need of money, period. It's especially in these tough economic times and pandemics. Absolutely, they're looking for money, and this is one way to get it. I was remiss, Mel, in thanking the executive directors of our local 8 dental societies that have supported our webinar series now for 2 years. We're very excited to work with them. They're all wonderful people. Folks, please, if you're not getting involved in your local or state or national dental societies, that is the future of your profession. It really is. So we would encourage you to do this. I want to thank Leah Dishian from the San Gabriel Valley Dental Society, Greg Orloff from the Los Angeles Dental Society, Kurt Thornton from the San Fernando Valley Dental Society, Megan Francis from the Orange County Dental Society, Michelle Schneider from the West Los Angeles Dental Society, Kristen Avina from the Harbor Dental Society, Laura Peterson from the Tri-County Dental Society, and Linda Lacuzna from the Santa Barbara Ventura Dental Society here in Southern California for helping to support our webinar series. Please make sure to tune in. Our last webinar series of the year, our last webinar of the year is going to be a week from today, right at this time, from 9 to 11 California time, December the 9th, with Kathleen Johnson. It's the third of our 3-part transition series, and Kathleen has completely rewritten her lecture. She's going to talk to buyers and sellers of dental practices about the good, the bad, and the ugly of when you look at your management reports. Is this a good practice? Sellers, do you have a good practice that buyers are going to want to buy? So this is really good information. Mr. Schwarz, it is always a pleasure to work with you. You are a wealth of knowledge that I could only dream of getting my hands on, having not been part of Eide Bailly until about 2.5 years ago. So this is great information for those of you that are listening on demand, if you will. Please feel free. Our number is up here. Give me a call if you are not happy with what kind of CPA services you're getting. We are very proud of the way we take care of our clients here in Southern California and across our offices at Eide Bailly in the Western United States. I'm at 657-279-3243. You can also go onto our Eide Bailly YouTube channel, and you will see Mr. Schwarz there talking about a bunch of other things other than just taxes for dentists. And we have all of our webinar series are up there. My podcasts are up there. And Eide Bailly puts out I believe plethora is the right word, of content to help businesses grow in anything. Well, Mel, I wish you nothing but a wonderful, happy holiday season. And to all of you, happy holiday season and a very prosperous 2023. Promise me that you're going to work on your practice, not just in your practice. And we're going to have some more stuff for you coming up in 2023. So Mel, have a wonderful weekend. Folks, have a wonderful weekend. And thank you for joining us on this webinar.
And thank you, Art, for allowing me to be a part of this. And all everyone, the best for this year, the best for next year. Absolutely. And I look forward to talking to all of you in the future. If you have questions about the part that I raised, please feel free. Email is the easiest way to reach me. But do not hesitate to drop something in the email if you have any question at all.
All right, Mel, thank you. And with that, folks, we will say goodbye for today, and we'll see you next time, hopefully
care.
next week. Thank you. Bye-bye.